Wake up. This isn't just another trading week. We are walking into a brutal dual CATASTROPhic gauntlet. Wednesday, February 11th, the delayed NFP hits with brutal benchmark revisions. Then, Friday the 13th, 8:30 a.m. Eastern Time, the CPI inflation bomb drops. If you're not sweating, you're not paying attention. This combination is a lethal threat to the Goldilocks hallucination. Investors are dreaming of cooling inflation and the stable growth. But this week, that dream faces a total bloodbath. If these numbers don't align, the soft landing is dead on arrival. Let's dissect the NFP. Consensus is bracing for a modest 70,000 job gain, but still depressingly low compared to historical averages. But the real poison, the benchmark revision. If the past was a lie, it means the labor market has been dying faster than Wall Street realized. If that labor data crashes, the Fed is cornered. Rate cut bets will explode as the market screams for a lifeline. But then Friday, we hit the CPI wall. Consensus, 0.3% month over month for headline and core. No room for error. Inflation is proving to be sticky and dangerous. Year over year is surging at 2.6%, stubbornly above the Fed's 2% target. An upside surprise isn't just a miss, it's a nightmare. That proves price pressures refuse to stay buried. So how will the market react? Let's break down the four possible scenarios. Scenario 1, the soft landing. If NFP is weak and CPI behaves, risk assets will rally. We're talking a massive green wave for growth-sensitive sectors, like biotech and regional banks. Watch the XBI and KRE like a hawk. Scenario 2, the ultimate market killer, stagflation. Strong NFP plus high CPI, that's a disaster. The USD strengthens, stocks get crushed, and yields skyrocket to the moon. This is the bloodbath scenario. Scenario 3, the Fed's headache. Strong NFP plus cooling CPI. It sounds good, but it's a trap. Strong labor gives the Fed a reason to stay hawkish, while low CPI screams for a cut. Expect a violent, directionless tug-of-war. The market will rip and dip simultaneously. Scenario 4, the nightmare mix. Weak NFP plus sticky CPI. This is the shadow of stagflation. Companies stop hiring, but prices keep climbing. This is the absolute worst case for the S&P 500. If this hits, the 6,720 level won't just break, it will evaporate. If a bloodbath occurs, you better be holding put options. High-value tech stocks will be the first to burn. But wait, there's a secret the pros use, the Volatility Crush. History proves that VIX usually crashes after these reports. Why? Because uncertainty is finally eliminated. Market participants buy protection before the news, then dump it the moment the numbers hit the tape. The data doesn't lie. VIX closes lower 70% of the time on NFP days. And for CPI, since 2021, the median VIX drop is a staggering 4.3%. Clarity is the market's drug of choice, even if the news is just mediocre. Remember September 2022? That was the exception. Core inflation shocked the system. The S&P 500 plummeted 4.3% in one day. VIX surged 3.4 points. Extreme surprises are the only thing that can save volatility bulls. So, what is your battle plan? Rule number 1, manage your risk. Shrink your positions before the data drops. Don't let a flash crash turn your life savings into a bloodbath. Listen closely. If the S&P 500 breaks below the 6,720 level, the trend is dead and I am out. No mercy. This week is brutal for gamblers, but a goldmine for the disciplined. Analyze the Fed's path, not just the headline. Subscribe now for the fastest updates. Let's win this trade.